We still have substantial work to do here. Turning to our non-core assets, we are underway with a sale process for Village Medical while continuing to evaluate the best options for Summit CityMD. We are encouraged by the leadership of new CEO, healthcare veteran.
Hi, I'm Max Ganek, a trader at SMB. Today we're going to do a
We still have substantial work to do here. Turning to our non-core assets, we are underway with a sale process for Village Medical while continuing to evaluate the best options for Summit CityMD. We are encouraged by the leadership of new CEO, healthcare veteran Jim Murray. To be clear, our ultimate intent to exit is unchanged, and we remain committed to redeploying any proceeds to reduce our net debt and improve the health of our balance sheet. Importantly, we improved free cash flow this quarter with decreased capital expenditures and higher adjusted operating income, excluding the non-cash impact of sale leasebacks. Longer-term generation of positive cash flow remains a key priority for us in the context of litigation, opioid payments, debt, and our current dividend. Continued progress on cash flow will require meaningful action and focus. In conclusion, we've shown progress on our priorities over the past quarter. And while we have a lot of work ahead of us, this progress underpins our belief in delivering a successful turnaround. I will now turn it over to Manmohan to review our financial results.
Thank you, Tim, and good morning, everyone. Overall, first quarter results were better than our expectations. Sales increased 6.9% on a constant currency basis, with growth across all segments. Adjusted EPS of 51 cents declined 23% year over year and on a constant currency basis. This decline was entirely driven by prior year sale leaseback gains and lower Cencora equity income. Absent these two factors, continued cost discipline in U.S. retail pharmacy and growth across U.S. healthcare and international businesses were partly offset by challenging U.S. retail market trends. GAAP net earnings for the first quarter included after-tax charges of $252 million related to footprint optimization program and $152 million non-cash charge related to fair value adjustments on variable prepaid forward derivatives related to monetization of Cencora shares. Now, let me cover U.S. retail pharmacy segment. Comparable sales grew 8.5%, driven by pharmacy and partly offset by decline in retail sales. The footprint optimization program negatively impacted total sales during the quarter. AOI decreased 36% versus the prior year quarter, including a $184 million headwind related to prior year sale leaseback gains and lower Cencora equity income. Absent these impacts, AOI declined due to lower retail sales, partly offset by continued cost discipline. Despite a $160 million headwind from prior year sale leaseback gains, adjusted SG&A was flat to last year. This cost improvement was largely driven by our initiatives to modernize our store-level demand forecasting and labor deployment tools. Let me now cover U.S. pharmacy. Pharmacy comp sales increased 12.7%, driven by brand inflation and script volume, partly offset by lower vaccine volume. Comp scripts excluding immunizations grew 3.5% in the quarter, and we held script market share. Pharmacy services performed better than our expectations during the quarter, as higher margin for COVID-19 vaccines was offset by the lower overall vaccine market volume due to the weaker cough, cold, and flu season. Pharmacy adjusted gross margin declined versus the prior year quarter, negatively impacted by brand inflation and mix impacts and net reimbursement pressure. NADAC changes in November did not have any material impact to the gross profit in the quarter. Turning next to our U.S. retail business. Comparable retail sales declined 4.6% in the quarter, which was lower than our expectations. There are two key drivers. Third-party data shows flu, cold, and respiratory activity over 40% lower compared to the prior year, which, paired with the warm weather through November, led to a much softer cough, cold, and flu season. This dynamic negatively impacted comparable retail sales by approximately 270 basis points in the quarter, including the impact from the attached basket, which was about half of the comp sales decline. Second, the consumer backdrop also remains difficult, with the promotional environment and continued channel shift impacting our discretionary categories. Retail adjusted gross margin declined year over year, negatively impacted by pricing and promotions, as well as lower sales related to cough, cold, and flu. Turning next to international segment, and as always, I will talk in constant currency numbers. Total sales grew 6.5%, with Germany wholesale increasing 11.3% and Boots UK up 4.5%. Segment adjusted gross profit increased 3%, with growth across all businesses. Adjusted operating income was up 16%, led by a strong retail performance in Boots UK and growth in Germany, partly offset by cost inflation and technology investments. Let's now cover Boots UK in detail. Boots UK continues to perform well. Comp retail sales increased 8.1%, with gains across all categories. Boots.com sales increased 23% year on year, aided by a strong Black Friday performance, and represented 22% of our UK retail sales. Turning next to U.S. healthcare. Sales of $2.2 billion increased 12% compared to the prior year quarter. VillageMD sales of $1.6 billion grew 9% year on year, despite the impact of clinic closures. The increase was driven by growth in full risk lives and fee-for-service revenue. Shield sales were up 30%, driven by growth within existing partnerships. Adjusted EBITDA for the first quarter was $70 million, up sequentially, and an improvement of $109 million compared to last year, reflecting the growth at VillageMD and Shields. Turning next to cash flow. Operating cash flow in the quarter was negatively impacted by the seasonal inventory build in the U.S., UK, and legal payments of $137 million. Year-over-year free cash flow improvement benefited from decreased capital expenditures and higher adjusted operating income, excluding sale-leaseback, which does not impact free cash flow. We remain on track to achieve $500 million in working capital initiatives and are currently ahead of our target for a $150 million reduction in capital expenditures. While we do see opportunity for further reduction in CapEx, we have plans for investment later this year in our stores and technology to support them. During the first quarter, we reduced our lease obligations by $652 million. We remain committed to improving our cash flow generation and net debt position through a combination of operational actions and asset monetization activities. As Tim alluded to, we also continue to evaluate the appropriateness and size of our dividend as part of our capital allocation policy. Our priority for fiscal 2025 is to stabilize our core performance while we make progress on the longer-term strategic and operational turnaround. Our progress to date is reflected in our reaffirmed adjusted EPS guidance of $1.40 to $1.80. We continue to execute on cost savings, inclusive of our footprint optimization program. We continue to expect $100 million in AOI benefit from footprint optimization program, with working capital benefits and sale proceeds from owned locations significantly higher than cash closure costs. We are also encouraged by pharmacy services results to date. We believe the impact of lower than originally expected vaccines volume to be offset by higher margin on COVID vaccines. The recently announced NADAC changes are expected to be less than a $50 million negative impact on pharmacy margin for the remainder of the year versus our original expectations. However, as we think about rest of the year, there remain certain risks to our outlook as well. The weaker cough, cold, flu season and continued challenging consumer discretionary spending are impacting our retail sales in the U.S. We now expect retail comp sales for fiscal 25 to decline approximately 4 to 5% compared to our prior outlook of down 2 to 3%. While the first quarter results are encouraging, we are maintaining our guidance range considering the challenging U.S. retail environment. With that, let me pass it back to Tim.
Thanks, Manmohan. Before I open the call up for Q&A, let me leave you with a few closing thoughts. Our first quarter results demonstrate that we are executing against our long-term strategic priorities. Importantly, we believe our approach to 2025 payer contracting supports our expectation for future stabilization in our pharmacy business, and we're still in the early stages of getting to a better outcome on our drug procurement costs. We're also executing on items that are in our control. Our initial wave of store closures has performed better than expected on multiple facets, including script retention and employee engagement. This gives us increased confidence in our centralized, deliberate approach to this process. Also fundamental to our turnaround is financial discipline. While we are pleased with our first quarter results, there is more work to be done as we aim to strengthen our balance sheet and to ensure longer-term positive cash flow generation. We remain committed to achieving a retail pharmacy-led turnaround underpinned.
Our first question comes from the line of Lisa Gill from J.P. Morgan.
Thanks for taking the question. Tim, I'm encouraged by the comments that you made around the levers to lessen reimbursement risk and the fact that contracts for 2025 are done. But can you maybe just give us a little bit more color on, one, what does that new reimbursement look like? And two, when I think about contracts are generally 3 years in length, so should I be thinking that for calendar 25, it's roughly a third of your book of business that has some type of new reimbursement metrics that are tied to reimbursement? That would be the first thing. And then secondly, just really want to understand the script retention. You talked about script retention being better than expected. Can you maybe just give us a number around that?
Sure. Thanks, Lisa. So the new reimbursement, actually, let me answer the other part of your question first, which is you're correct that the arrangements that we have with PBMs typically are multi-year. Doesn't mean that we don't, by the way, come back to the table and open them up in response to opportunities or changes in the market. But generally so, we haven't said exactly what percentage it is, but it was a meaningful percentage. So your number, broadly speaking, is probably about right. And in terms of what the actual arrangements themselves, how they've evolved and what they look like, I think what you've seen is a couple of things. One is we've been successful in aligning with PBMs to create a category for higher cost drugs, for example, where in the past those drugs would fall into the basic reimbursements and they were massively insufficient in certain cases. We've highlighted GLP-1s as an example. And so that's one of the things that we've done in many of the contracts. In other contracts, what we've seen is a rebalancing of brands and generics to more appropriately sort of reflect the environment today, both in terms of the absolute environment and how it's going to be evolving. Because if you really take a look back, and I know I've spoken about this before, what you had was essentially us performing well on generics, but it being.
Good day, ladies and gentlemen. Thank you for standing by. Welcome to Walgreens Boots Alliance fourth quarter 2024 results earnings conference call. At this time, all participants are on a listen-only mode. After the speaker's presentation, there will be a question-and-answer session. To ask a question during the session, you will need to press star 11 on your telephone.
And those outlined in our latest Form 10-K filed with the Securities and Exchange Commission. We undertake no obligation to publicly update any forward-looking statement after this presentation, whether as a result of new information, future events, changes in assumptions, or otherwise. You can find our press release and the slides referenced on this call in the Investors section of the Walgreens Boots Alliance website. During this call, we will discuss certain non-GAAP financial measures. These measures are reconciled to the most directly comparable GAAP financial measures, and the reconciliations are set. Important rebasing year to drive longer-term value creation.
And before I conclude, I wanted to say a few things about how we're supporting the communities recently impacted by Hurricanes Helene and Milton.
The U.S. Healthcare segment finished ahead of expectations for the year, delivering $66 million in adjusted EBITDA. Sales of $2.1 billion increased 7% compared to the prior year quarter. VillageMD sales of $1.5 billion grew 7% year on year. The increase was driven by growth in full risk lives and fee-for-service revenue, partly offset by the impact of clinic closures. Shield sales were up 28%, driven by growth within existing partnerships. Is that our customer is likely to remain under pressure and continue to demonstrate the same price $1 million. We anticipate an AOI headwind of approximately $400 million from lower sale-leaseback gains and Cencora equity earnings. This will not have any impact on free cash flow. In fiscal 2024, we began to refocus our financial philosophy. This includes decisions to simplify our financial reporting, such as wind down of the sale-leaseback program and Cencora share sales, but also in terms of capital allocation priorities. As we monetized assets in fiscal 24, we reduced
Sai qual è il miglior